Ladies and gentlemen, my name is Jesse Fergali, and you're listening to Working Capital, the real estate podcast. My guest today is Kane Willmott. Kane is the co-founder and CEO of IQ Offices, a luxury co-working company with locations in Toronto, Vancouver, Ottawa, and Montreal. Kane, how you doing?
I'm good, Jesse. How are you doing?
Doing great today. So, for those that don't know, IQ Offices is the largest Canadian-owned co-working operator with 8 locations in downtown Toronto, Vancouver, Ottawa, and Montreal. And I think I've got everyone there. Is that right, Kane?
You got it.
Perfect. So, Kane, for those that don't know who you are, IQ Offices, what we'd like to do with most guests is basically have a little bit of a backgrounder on how you got into the real estate space, and then maybe we could talk a little bit about IQ and how you got into that world after.
Great. Yeah. Well, I'll try and make it a short story because I've been in the business quite a while. But I started at a university at Price Waterhouse, large accounting firm, and I found out very early on that really wasn't for me in terms of the job and what I was doing every single day. But it taught me a lot about what I wanted to do really with the rest of my career. And I moved to Toronto. I went to school in Waterloo, moved to Toronto and got into brokerage in 1998 and had the great fortune of working for Craig Smith and Brian Murphy. Craig Smith started Ashler Urban Realty, and I went over and started that with him about a year into my career. So I had the opportunity to really go through starting up a business very early on in my career. In a fairly low risk way from an opportunity cost perspective. And I had a lot of great mentorship and guidance from Craig Smith. So from there, started another brokerage with another partner, ultimately took a company public, and then started a company called Spire Commercial Realty, another brokerage with Alex Sharp, who's my business partner now in IQ Offices. So we started Spire in 2009. Focused on investment sales. And then in 2012, we got into IQ. So that's like the short genealogy of how we got to where we are now. But I can say in terms of why we started IQ, I started in office leasing in 98. And what I found in 2011, when we started looking at this as a business model, is that office space was transacting in the exact same way in 2012, 2011, as it was in 1998, like in every single way. And it just seemed like over the 10 years prior, so much had changed. So many industries have really went customer focused in terms of, you look at, Apple and, Amazon, you look at these companies that really put the customer at the center of the user experience and thought from there outward of like, how do we create this great experience for them? If you think about a difficult consumer experience, I would put office leasing in that category. It's very complex. It's very time consuming. There's a lot of risk involved, and there's a lot of it's very time consuming for the consumer. But it's just the way it's been done for so long. So when co-working came out, and I saw that you could transact on a 7-page agreement, that the space was already built out for you, that you had an operator running the space and doing everything for you, this just made sense to me. I mean, it started with math and from the perspective of how much you could rent an office for versus what you pay for all the inputs, but what I found early on was that there was such a value add to the customers when you were able to really match up their current demand with the supply and give them exactly what they need when they need it in a very, very efficient way. And if you look at co-working operators, we spend a lot of time thinking about how to reduce friction and take friction out of the transaction process. There's a lot more to it, but that was really at the heart of it when we started this business. And we looked at, putting all of our agreements into digital format so that people could sign them digitally and get them back to us, and they could comment online, and you can go back and forth, and making things happen really quickly. And for an ex-broker, this was something that really resonated with me, and being able to do these things quickly, because I've just been through so many transactions. Jesse, you might be able to sympathize with this. There's so many times where you'd be working on a transaction, it would get, you'd be, a year into it, and you'd have a document and it's got one signature on it, but doesn't have that second signature. And you've been working for a year on this and the second signature doesn't come and the whole thing falls apart. And it's for whatever reason, the company changed. There's been change in ownership of the company, the change in management, the merger, whatever the situation is, it happens, right? And it's really challenging from the broker's perspective. And I thought this is a real great opportunity. If you look at our customers being twofold from the acquisition perspective, the brokerage community as well as the customers themselves, right? create a great UX on the way in, right?
Mm.
Where they can get what they need quickly, where they can make decisions that they can feel confident in, right? And make things happen in an expedient way and match up that demand with the supply. So that made a lot of sense to us, and that was at the heart of why we got into the business. And from there, what we were really lucky with is that we had multinationals, we had WeWork come in and just pour a ton of money into this industry and made investments in relationships with large organizations. The biggest challenge for co-working in 2012 was awareness. Most companies just didn't know what it was, what we do, or if they did, they had limited exposure to it, and they thought it was just for small companies, right? Or 1 and 2 person offices, that sort of thing. They didn't realize that this was a greater solution for so many other needs in terms of the workspace ecosystem.
I'm curious. So you mentioned 1998. You're a little bit older than me. I'm a little bit older than the younger guys and gals in our industry. And I think the landscape today, if you just got into the industry, you mentioned those companies, you think about co-working as, in a certain way. 1, 2, 3 year leases or subleases is not crazy uncommon. Whereas I think, when 2005, 2000, 2010, you're seeing these long-term leases. So for those that weren't there at kind of the beginning, and you mentioned even starting your career in the late 90s, what was the co-working landscape? Was it just Regus? Was there, what did that look like at that time?
So this is really to the point of it. In '98, and right through until the early 2000s, I had no exposure to co-working myself at all. Even though I was in office leasing, there were operators out there, to your question. So IWG Regus at the time was the largest provider of co-working spaces. They didn't call it co-working at that time. They were calling it executive offices or shared workspaces, whatever the term was of the time. But there were other operators, independents, lots of independents in the market. But they were very cookie cutter. If you looked at co-working spaces in the early 2000s, the mid 2000s, you were seeing most co-working spaces focusing on 1 to 2 person offices in locations where there was enough demand in order to fill up those offices, because they would have churn in them. So, and you still have some of those in the market today that have been around since the 80s. And if you look at their fit out, they've obviously made changes and innovated. But the structure was there, and that was really their primary customer.
So you mentioned 2012 and this idea that co-working is not just for the small user. Now, doing these deals, I want to get to the truncated contract and, not having to sign a 100-page lease. But before we get there, this idea that you can do co-working with enterprise, who kicked that off? What was the misconception there, and how was that problem solved?
So if you're looking back at 2012 and up to the pandemic, I'll speak to that. And that's different than what we're seeing post-pandemic. Pre-pandemic, what we saw was large companies were using IWG, that's Regus, because they had global presence, and they would use them to go into markets where they wouldn't need an office space. They would have 1, 2, 3, 5 people in that range. It's not that Regus wasn't building bigger offices. Sure, they have bigger offices, but for the most part, large organizations that were using Regus were using them because they didn't want to take on a long-term commitment in a market where they have a very small team. That was the MO of them using the space. So Regus had that customer. What happened was, when WeWork came in, they poured so many marketing dollars, and TI money and everything else that they did in order to bring awareness to the space into the enterprise customer. That really was their focus. Their focus was, taking a building in downtown Manhattan and leasing the entire thing to IBM, but doing it on a co-working basis and having it be completely serviced and tailored to their needs. So they grew extremely quickly, and they went to that customer and said, we'll be a solution for more than just your small space requirements. We will be a service solution for all of your requirements. The vision, I think for many of the mandates that they had with enterprise companies was ultimately for them to go in and service all of their workspace at some point. That's the vision. But what they were able to do is break into that market, speak to the enterprise customer, and say, you don't need to have your entire portfolio locked into long-term leases. Most of the people who are running the real estate at the time understand that if they guess wrong on a long-term lease, it's extremely costly. So them being able to go in and do a 2-year deal, and we're not going to talk about the risk profile of that business model, but from the consumer's perspective, IBM be able to go into an asset in downtown Manhattan for 2 years and then figure it out after that there's a tremendous amount of value involved in that. And enterprise customers started seeing that all the way across the whole, globally, across their entire portfolio. So they started using co-working as not just for small markets where they only have small teams. They started using it for major markets where they have large teams. And they would look at, instead of taking on an extra 100,000 square feet on a 10-year term, they would take down 100,000 square feet or 50,000 square feet in a co-working space where they could densify better. And they would use that space on an on-demand basis. When I say on-demand, 1 to 2 years, and then figure it out after that. And it just brought down the risk profile related to that space and how they were going to be able to utilize that space and whether they were going to have waste in terms of the term that they have committed for that specific location. So WeWork really brought them to the front. WeWork has done a tremendous service for this industry by bringing the awareness to those customers and really servicing them well across multi-markets and really showing them that you should be outsourcing this. Servicing, building, procuring, everything to do with your workspace, you should be outsourcing this because we're the pros. We're the pros, and we can do it better, and we can do it faster, and we can deliver a great product for you and bring down your risk on it. So that's what happened in the market. For me, for IQ, that was luck. It was luck that we had SoftBank come in and pour all these dollars into WeWork and just have them grow gangbusters across the globe and then cement all these relationships and really change the way that many people who were involved in the real estate decisions in terms of workspace just changed the way they started thinking about it. And the options in the market became much more broad than they were previous to WeWork getting involved.
So prior to that post-pandemic era, so we're talking still prior to that, I've seen in the market and other major markets that we operate in, Avis & Young as a company, we've seen co-working kind of trend up, be on people's radar, get oversaturated in some markets, or at least that's what the headlines say. Then we see a pullback. We see landlords initially being a little wary of co-working and then buying in fully. And then so through all those kind of ups and downs, what do you think were the biggest challenges initially with buy-in from the landlord community from the co-working point of view?
That is a great question. So I think from a macro perspective, if you look at Canada as a country and the way that we do business in this country, we are very conservative. We're not. We don't take risks. We're not as entrepreneurial I'm talking in generalities, obviously, but in terms of what you see in the US. So, and what you see in Europe and the UK specifically. So if you look in the UK and you look in Europe, you are seeing many transactions happening with landlords, these partnerships happening. The landlords are bringing it in, they're activating the buildings, they're doing what needs to be done. There's all kinds of reasons for that. There's the entrepreneurial piece, number one. There's also concentration of ownership. If you look at the trophy assets in Canada, there's a concentration of ownership here where you have less of that in the US. So you have just a broader pool of landlords to speak to. And that means that you're going to have some that are going to be a little bit more outliers. They're going to say, I'm going to take on the risk of this because I believe in it. And when you have a smaller group, you're going to have a smaller sample. So you're just going to see less of it. So that's what we're seeing in Canada. Of course, when you look at some of the headlines in terms of what's happened on the co-working side, it is just headlines. You really have to peel it back. And I'm actually just in the process of putting an article together talking about the current vacancy in Toronto. And they talk about vacancy being at 18%. But when you look at your trophy assets, it's at sub 3. So, when you say that, co-working, it doesn't work, or you say that co-working, it isn't profitable, it's like, that is a wide sweeping statement that really doesn't tell the whole story. But it does affect the cognitive bias in the industry towards this is risky, right? And so when you look at a landlord managing the real estate by definition is a passive asset. It's supposed to be passive. If you're a REIT, you're not allowed to get involved in operational pieces of the business because that takes away your REIT status. It's supposed to be passive. It's not supposed to be an operating business. But what's happened is, and going back to the customer-centric piece, is the customer no longer wants to buy the bond that the landlord's offering in terms of just sign a 10-year lease. They're not interested in that. Sign a 10-year lease. I'll give you $50 and you spend the extra $200 to build it out. You take on the risk, right? They're just not interested in that. And I think as building owners, and I'm a building owner as well, is, we've had we've lived in a sub 3% vacancy environment for a long period of time. And that means that you can call the shots, and it means you can say what is going to happen in terms of how that transaction is going to be structured and how it's going to be offered into the market. Now, when you see, 18% vacancy rates across the city, the landlords that are going to win are the ones that stop thinking of their asset as being a passive asset and thinking about it as being an operating business. And if they do that and listen to the customer, because that's what the customer wants. The customer doesn't want to sign the long-term lease. They want to do the short-term deal. They don't want to build it out. They want you to build it out, right? They don't want to do a long-term. They don't want to sign the long agreement. The way it's been transacted and the whole structure of the transaction in the past is not what the customer wants. There's a mismatch right now. And that's why you're seeing the vacancy rise in a lot of ways, but you are seeing specific bright spots, some spots where the assets are performing extremely well. And it's really because I believe that the needs of the customer are really matching up with what the offering is. And if you look at the co-working industry in general, it has been doing very well. Like it's high occupancy rates, lots of demand, more so than pre-COVID. Like we are seeing a lot of demand because if you look at a co-working space, it really is giving the customer what they want.
Yeah. And I think you alluded to it there. We're seeing in a lot of markets, and we've done a white paper on this for Toronto, or at least some, I don't know if it's been formalized to that extent yet, but basically the vacancy rate, for this asset class, AAA, and then trophy, and then going all the way down to 4.3% interest, 4.3% vacancy from the high teens. So I'm curious now today, from your vantage point, you're looking at the co-working world. You've seen it ebb and flow over the years. From my point of view, we have definitely seen a change from the tenant appetite. They want to monetize space even more so than ever. They want to be connected. Transit is become more and more important to them. Suddenly, character assets outside of the city in the urban centers or urban areas are not as appealing, where they were pretty funky and cool 5 years ago. Number one, are you seeing the same thing? And how does that impact co-working as opposed to, you're just regular tenant that's looking for a lease or a sublease?
That is a great question. So I have to unpack that a little bit,
Sure.
and really look at what's behind the decision makers process, how the decision makers thinking about it, and what we found. And I spent a lot of time talking to the brokerage community, to the landlord community, and then to our members, and a lot of like office space, workspace decision makers. I spent a ton of time talking to them because that's really what our primary customer. And what we've seen really change from pre-COVID to post-COVID, and this will be a long way to answer your question, but I'm going to get there. So what we saw pre-COVID was that real estate decision maker, when I was talking to them, I was saying, like, if you're going to look at a co-working space, why? Like, why are you coming to us? I really want to know, because whatever we're doing right, I want to make sure we do more of it, right? And they really said that it was, and I'm paraphrasing, but it was workspace, like just like on cruise control. Like, I need workspace, right? So I've got 100 people, I need 100 desks, right? So they would say, I need 100 people, I got 100 desks, I'll get a designer to come in and build out the space and make it look like, our company brand and those sort of things. But ultimately, my job from a real estate procurement perspective is to estimate what my headcount is going to be between now and 5 years from now, if I sign a 5-year lease, or 10 years from now, if I sign a 10-year lease, and make sure I build in some buffer, make sure I get it right. Make sure I don't take on too much space, but make sure I take on enough space. Make sure I have a little bit of extra space so that I can grow into that space. That's really what they were looking at, right? That was the key. So success was, I can match my head count to the term of the lease that I'm signing. That was success from a workspace compliance perspective. Now, talking to those same people, or the same people that are in those roles, it's been a complete shift. They don't look at workspace in the same way. They don't look at it from the perspective of how many people do I have and how long a lease am I going to sign. They look at workspace as a return on investment, because it's not workspace by default anymore, right? It's not like, I have to have workspace. There is the option to not have workspace, right? And so I'm not going to talk about, whether, people work better together or not together, but let's talk about the group that are going to take on workspace, because that's who we're really talking about, right? So we're talking about groups that have already bought into the idea that our team is going to be more productive if they're together, right? So that's why they have office space. The only reason to have office space. Then they're looking at it and saying, okay, so if I'm going to invest in office space that I don't need, I need to make sure that I get a return on investment. Every dollar that I put into my workspace has to enhance the productivity and output of my team. Most companies, their biggest asset is their people, right? Their biggest expense line item is their people. So they're looking at it from the perspective of, I'm paying an engineer $250,000 a year. How do I get the most out of that engineer? So if they're in the market for workspace, they're of the mindset that if I put my engineers together, they're gonna produce more. So that we're just gonna use that as a given. Then from there, they say, okay, now what I need to figure out is, how do I attract and engage that talent? Like, how do I get them into the space? How do I get them to want to come to the space without me mandating it? Number one. And then number two, when they get into the space, how do I engage them? Like, how do I make sure that I'm getting the most out of them in that space? So it's a workspace experience thing. And that's really what we speak to. And when I talk to them about, like, why are you using coworking? So it used to be, I'm using you pre-COVID. I'm using you guys because you do a great job at what you do. And ultimately, I don't want to sign a 10-year lease and I don't want to pay for the fit out. So it's just a financial decision, from an expense line item perspective. And that's why we use you. If we had more sight lines into a longer period of time, I would take on my direct space. That's what they would say. Post-COVID, entirely different. They're looking at it as a revenue driver. They're looking at it as, I'm going to drive revenue by attracting and engaging talent. So that's how they're looking at it. They're saying, I'm going to invest in office space. I'm going to get more output. So they have to make sure that they do that. But there's a risk. So the risk now isn't that I didn't take on enough space and I need more space. The risk now is that I spend all this money on office space and no one comes. Or I spend all this money on office space, and when they get there, they're not engaged. They're not working together, right? They're all going into their Zoom closets and no one's talking to each other. We're not getting the production that we'd like to get, because what they look at is that $250,000 salary, and they look at, how do I complement that, right? How do I get more out of that individual and that team? So with that, they have to look at, what is it I need to do to attract and engage? And that's really what we talk to them about. Like, they say, you know how to do that. How do I know? Because when I walk into your space, and I'm speaking as the real estate decision maker, when I walk into your space, there's people everywhere, right? And when we tour around your space, I see the coffee machine that you put in there, and I see the massage chairs that you put in, and I see all the breakout spaces, and I see that it's busy and it's vibrant, and there's people in the space. It's working. And I also see that your location that is, close to 60,000 square feet is full. So, I mean, it must be working, right? Because otherwise, why would people do it? And we have the great benefit in our industry of being able to just beta test all the time, over and over again. We survey our members. What would you like? Do you want yoga? Do you want this? Do you want that? What kind of snacks do you like? We're always asking, and we're always innovating. We're trying to figure out always, what is the best thing? What is the best new thing that's going to make this an exceptional product? And we hope we're always delivering an exceptional product, and that's always our aim. But when we talk to these companies, they say, if I invest in workspace at IQ, I know that I will attract and engage the talent, because I know it's what you guys do. Because I can literally stand in the space and I can see it in action. If you look at a space, and I'll give you an example, because we have the opportunity to tour all kinds of spaces of tenants that have taken on 20,000 square feet, but they need 10, 7, whatever it is. There is few things that are more depressing than walking into a workspace with half the lights off and 10 people working in an open area, right? Like, that is not engaging. And I had the benefit of having a discussion with a gentleman who's in the restaurant industry, and he said something, and it was an aha moment for me. He said, the way that they build out, we're looking at a floor plan. He was saying, the way that we build out our dining rooms is that we have the bar, and then we have a seating area, which is our core area. And then we have areas we can cut off depending on the night, because on Monday, there's not as many people there as there's on Thursday. And on Thursday, there's not as many people as there might be on Saturday night. So what they do is they create this like environment, right? A vibe within the space. And I think, what's interesting is the companies, when they're looking at it now, and I think this is why you're seeing like all this weakness in the lower end product in the market. Because companies now, like I've seen product downtown Toronto that's sub 40 gross, right? Like, what a fantastic deal, right? From a per square foot transaction perspective. But if you weren't thinking about it as a cost savings and you were thinking about it as an investment, if you take down that space and you take down extra space and you walk into the restaurant that's maybe beautiful, but it's half empty, right? You don't want to be there. So that's the engagement piece, right? So that's there's a lot to it. There's a lot to putting it together and really making sure that you're getting that return on the dollar. But, the companies really are starting to recognize, and a lot of the large organizations are really coming off the sidelines right now because they're starting to like work through their portfolio and let go of some of the space and sublease some of the space, and have some expires that are coming up. We've done 3 transactions over the last 6 weeks that have been with companies north of $15 billion that took down space within this one location that I'm sitting in today. And every single one of these companies are saying the same thing. They're saying, I'm looking for the best space, Yeah. And the interesting thing is many of these companies are downsizing, so they have the budget. So the answer, when you look, of course, there's going to be companies in the market that are always going to say, I want the cheapest space. There's always going to be that customer. But I think, who we're going after and who our customer is that customer who says, I want the best. And we want to give them comfort that when they commit to like even a 1 or 2 year term, that they have here at IQ, that they're going to get return on those dollars in the way of productivity and output.
No, that makes sense. First of all, I love that idea of the restaurant compartmentalizing their space because it's true. It's nothing like a 40,000 square foot floor plate and it's just empty. In terms of you said something that was interesting. You said that these companies, what they're worried about is putting money and dollars into real estate space and it going underutilized. Would the same thing not be true for the co-working space or co-working companies in general? Because to me, at least, the concept logically is that they should be properly done. They should be somewhat recession, not proof, but they should be able to weather the storm of a recession because companies are trying to be, trying to get shorter terms, trying to have a little bit more flexibility. Maybe they'll pay a little bit more because of that flexibility. But what we've seen in the news, you see WeWork, going through some of their troubles, for lack of a better word, over the last little while. And I think the public conception is that this was partly because of the inherent risk with co-working, whether true or not. So I'm curious, does that not same idea apply for when co-working companies are looking on taking on space? And would the logic kind of follow that you have to basically be in where you guys are in that high part of the market to be capturing the tenants you're talking about and kind of harken back to that 3-4% vacancy as opposed to 18% vacancy?
Yeah, it's so it's a difficult business is what it really comes down to, right? I mean, everybody says, their business is a difficult business. But I say there's 4 pillars in this business. There's things that you need to have in order to run a successful location. First of all, it has to have the right location. That's something you can't change. Second of all, you got to have the right deal structure. And that means that you got to have the right cost basis. You got to spend the money in the right places, and you got to spend not too much, or but you can't spend too little. You have to kind of you got to build what your customer is going to want. You have to build something that's going to sustain over the long term. In addition to that, you have to build out the right product within that market. So you have to look at building out the breakdown of the spaces. So if in downtown Toronto, the space that I'm in right now can accommodate 56 desks, right? If you are in Burlington, you don't want to build a 56 desk location, right? So that's extremely important. And then in addition to that, you look at operating it, and you look at selling it, and you got to look at operating and selling it. And operating and selling it is something that a lot of companies it's underestimate the difficulty in it, just the complexity of running the business. So even if you have a great location, even if you have a right deal structure, even if you've built the right product, you still have to sell it over and over and over again, right? And you have to make sure the customer's happy, and you have to make sure that your occupancy doesn't fall, because it's just, every single month, a big component of your space, a big proportion is going to come due, right? And members can give you notice. So you got to make sure that they're happy. So you got to run it and sell it over and over and over again. And you got to create a really great experience within the space. So if you have something that falls outside of those 4 pillars, right? Maybe it has 3, but it's in the wrong location. You could build the right product mix. You could have the right deal structure, and it could be really cheap, and you could run it super efficiently and have the best salespeople on the planet. But it's in the wrong location. It's on the wrong side of the city. It can fail because of that, right? You could have the great location, you could have the right deal structure, you have the right fit out, but just a very poor operator, not a strong sales team and not a strong operation team that are offering a great product. So you take away one of these pieces of the 4 pillars, what we find is that it starts to it starts to degrade, right?
Mm.
And that's where you start to see your vacancy creep up, and that's where you see problems. So so I really do think it's a business that you really need to understand. I mean, I've got my 10,000 hours. I got a lot more than 10,000 hours, but I've got those hours behind me to know what is a good location, how to build it out properly, right? What kind of deal structure can I afford? How much money can I spend on it? And, and ultimately how can we run this to make sure it's profitable, And of course, I can make mistakes too, but I have the benefit of 11 over 10 years of experience working through those challenges. One of the great benefits that we had early on is that Alex and I are both real estate guys.
Mm.
So we know what a good location is. And we started in Toronto, which is a market that I'd been in for a very long time. So I know that, if you go on this side of Yonge Street, or if you go on that side of Queen, or if you go on that side of University, I know that 2 blocks in the wrong direction makes a huge difference in terms of a good location within Toronto, because I worked in leasing for so long. So I think we did well in picking those locations. And then in terms of all the other 3 pillars, that's all stuff is hard knocks. That's all stuff we had to work out and figure out over the last 10 years.
No, that makes sense. I'd be remiss if I didn't ask you. You just mentioned a couple minutes ago that your logical customer is the office decision maker. The office is going through some turbulence right now. The future of office has been, the title of many podcasts, many shows right now, because it is such a question mark right now as to where we go. You operate in not just Toronto, but other major markets in Canada. What's your take on the office environment and how it's been changing? And I'd love to hear it from the perspective of somebody in your space.
In terms of how it's changed, how the offerings change, and what customers want now versus previously?
Yeah. I think to put a pin on it, if you think that the landscape of what the office it was 3-4 years ago, as you have a static office at 5-year, 10-year leases, as opposed to what you think the future is, do you think that it's going to be limited to the downtown cores? Do you think that, the office being dead is just a tagline that we're going to forget very quickly? I'm just kind of more of a, 30,000 foot view type of idea of it.
I love that question. So I can talk about what I see now, because that I know, and then I can talk about the future, which I don't know at all and could be completely wrong. So what I do see in the markets is that 5 days a week is very rare. We do have some members that have people 5 days a week in the space. It's really a preference of it seems to be a matchup of the decision maker within that company deciding what they want, and also to the employee as well. I mean, that's what I have seen. And I mean, maybe I'm not getting all of the honest feedback in terms of the people on site, but what I have heard from the groups that are on site 5 days a week, they want to be here. They're happy to be here. That's why they joined the company, because they wanted a company where they could come here every day. They're not interested in working in their condo or, remotely, whatever the case may be. Most companies are doing some sort of hybrid structure. And what I've seen, which is really interesting, is every company seems to be different. Like, with the exception, you can put some into the 5 day a week bucket, but like a lot of companies are using space 3 days a week, 4 days a week, 2 days a week. Some companies aren't using the space at all on a permanent basis. They come in for what we call sprint spaces. So they'll rent out a big office that has breakout rooms and meeting rooms and technology and team spaces and lounge spaces. And we'll bring in the food and beverage for them. And they'll bring everybody together and on a cadence. It might be every week, it might be every month, it might be every quarter, where they bring everyone together and they get the benefit of being in the office, but they actually don't have an office. They, sometimes they'll have a virtual address with us, meaning that they have, we collect all their mail for them. They use our address on their website, so forth. But they're utilizing the space in that way. And every company is different. Like every company has a personality. It's really interesting, and something that with the companies that I've really started to realize, and I really pay attention to it now. Especially with all the members that we have on site, different companies have different personalities, and the people there's somewhat of a group thing. People think the same way. Like, I think about Avison as an example. Avison is an awesome shop. I love everybody there. It seems everybody I meet is just is really nice and really welcoming and smart, and and just they attract. Avison does a great job at attracting great people. And it's because there's a personality. The company has a personality, and then the people within the company subscribe to that, right? The same values. And so, we see all these different personalities within our space, which is really, really interesting. And those different personalities start to match up in time with how they use the space. And we help them kind of work through that process by always innovating in what that we do, but then also looking at like, what other products do we need? Like that sprint space didn't exist 2 years ago. Now it's a product that we have, so we're looking at that. So the one thing I would say is very inconsistent in terms of companies. For me to say that there's a real trend towards this, the only thing I'd say was a trend against 5 days a week. I would say that we're seeing less of that. Outside of that, I would say most companies are using it in very different ways. Different markets are different as well. Just attitudes of a Vancouver market. They came into the office way more during COVID than Toronto did. There were restrictions, of course, but there is again a personality in the city. So if you go to Montreal, they do 5 sets. Work is a very social thing. So for people to not come to the office is taking a social component out of their life, and they miss that. Like a lot of the people in Montreal miss that, and they like to come downtown and they like to go for a drink after work and get together with their staff. And so it's just different, in the way that works. So you got the company, the people, the company, the environment that really all dictate how they utilize the space and all the different things. What we try to do at IQ is just keep on matching up our service and our product to different unique ways for them to solve the workspace challenges that they might be facing, and then to help them with like what we see other people doing with somewhat the same personality, right? Yeah. This is the same kind of company as you guys. This is how they use it, and so this is what we see. Crystal ball.
Yeah.
Crystal ball. I do think that in the fullness of time, you're going to see some continuity in terms of workspace. I think you're going to see more and more people come back to the workspace. I think most of the leadership likes having people in the office. I think, we're social beings. I know I'm more productive when I'm in the company of others. I just am, So it's not that I can't be highly productive remotely at home by myself. Of course, I can. And, I work from home most Fridays because I got a lot of stuff to catch up on, and I find it highly productive. But working from home all the time is very challenging. For me, it is anyway. And of course, that's my personality. So I can't, transpose that onto everyone. But I think you're going to start seeing more of that. I think you're going to see more and more people over time coming back to the office. Maybe it's a 4-day a week. Maybe it's a 5-day a week. I doubt 5-day a week. I think the technology has advanced to the point where people don't need to be in the office. You can have life integration. When I started in 1998, I had a computer that was like this big sitting on the desk and a phone. And I had a cell phone that cost me $5 a minute to use. So like if I wasn't sitting at my desk, I wasn't working, right?
Yeah.
Or like I was sitting at my desk and doing cold calls, or I was knocking on doors, right? But I was incommunicado and I was not by my phone, right? Now, I have my phone with me all the time. I work 24 hours a day. I work till the moment I go to sleep at night, and from the minute I wake up in the morning, I'm always thinking about it. I've got access to it. So I think that we need to think about how we work around that, and have more freedom around our space and allow people to integrate work into their life instead of the work-life balance piece. This is my personal opinion. This is just me saying. I think that there's great value if you, instead of the balance piece, you look at more of the integration piece where you're able to go and pick up your kids from school and take them to school, but you can still get things done. You can still be connected, and it gives you a great freedom to be highly productive, but also to be there and to be present, physically present.
Yeah, I couldn't agree more. I think there's going to be some sort of resting point or equilibrium where whether that's 3 days a week, 4 days a week will be the, quote unquote, the new norm. But I also think that the pendulum will swing the other way because we talk about privilege so much in society for different, different work environments. And, a lot of people don't have the privilege to just work from home. And then some don't have the privilege of a home that is conducive to working from home. So this idea that you can just say to a whole company blanket statement that you can work 4 or 5 days a week, I think there will be certain types of, like you said, personalities of companies that if 4 days, 5 days a week at home is something that you want, it might not just be this type of industry. It might be this specific company that you'd work for, but who knows? We're all just doing the crystal ball thing here right now. I don't think anybody really knows exactly where we're going to end up. Kane, I want to be mindful of the time. This has been great. I could do another half an hour, 45 minutes, talking about coworking and the future of coworking. What I'd like to do is just for those that would want to reach out or connect or just interested in IQ offices, where could we send them? We'll put some links in the show notes.
Sure. Yeah. I mean, iqoffices.com is our website. So certainly go there and you can reach out if we can service any needs that you have on the workspace side. Myself personally, you can just go to my LinkedIn. go to my LinkedIn. I try to stay up to date on that. So when I get messages, I do my best to respond to them as quickly as I can. So if you want to connect, just reach out to me on LinkedIn.
My guest today has been Kane Willmott. Kane, thanks for being part of Working Capital.
Thank you for having me, Jesse.